Good morning, Making Moves family. We're back. It's 10 o'clock on Tuesday, so your favorite hosts, Tim and Tim, are doing our Facebook Live. And this week, we got something really exciting to talk about. Last week, we talked about building your personal brand and why it's so important in order to raise money. Well, the second piece of that is where are you going to find that money and what type of money are you looking for? So without further ado, Tim Vest, how you doing today, buddy?
As always, great.
It's a wonderful day in tax world today, March 15th.
Yeah. Hopefully folks are getting those K1s. Hopefully if you're a syndicator, you're getting those K1s out. I tell you what, there's nothing that shows you, in my opinion, there's nothing that shows you how busy the real estate and the multifamily world's been than this time of year when you're trying to chase down your accountant to get those documents up, and they tell you how backed up they are.
We're fighting that across the board. One of the other properties that I manage without Tim, we had to file an extension on it, unfortunately, just because the CPA was so backed up. Between personal tax returns and now business tax returns and partnership tax returns, it's just the first 4 months of the year, man, for those tax guys, it's crazy.
Yeah. We're seeing the same thing, even to the point where a few weeks back we had to go back to the accountants and say, because we have syndication deals, we got some JV deals, things like that, and we had to tell them, hey, focus on these because these are our syndication deals, and we want to make sure those are prioritized first. And if the JVs come late, that's fine. We'll figure that out. But yeah, filing those extensions, it looks like it's going to be kind of a normal way to do business for a little while here.
Yeah, definitely. Well, all right. So that kind of leads into today's topic of where are you going to find funding for your deals and what kind of money are you looking for? There's three types of money that you could be looking for on any one of your deals. You could be looking for debt partners, equity partners, or JV, joint venture partners, which Tim just alluded to. There's a common misconception that if you find a good deal, people are just going to show up out of the woodwork and start throwing money at you to give you a good because they want to receive a good return into your amazing deal. Tim, what do you think about that?
Sure. I mean, it's like finding the leprechaun at the end of the rainbow, right? And no reference to the fact that St. Patty's Day is just around the corner here, but yeah, man. I think there is this notion that if you get a screaming deal, the money will just show up. That's not true. I think some of us have been a little spoiled lately because there is so much money out there that even myself included, sometimes it does kind of feel like it's just out there flying around. But the truth is you got to dig the well. You got to make sure the well's primed and ready to go. And if you've done that and you find a good deal, it will likely be there, but it still takes work,
Yeah. And people don't invest in the deal. They invest in the operator, folks. I mean, I feel like that's common knowledge nowadays, but it's important to kind of talk about these subjects over and over and over and over again and just bring it up all the time, because what you heard 6 months ago might impact you differently now, because 6 months ago, you might have been building your personal brand. You might have been building your platform. You might have been building relationships with people in order to raise money from them. And now that you have those relationships, now you get a good deal. Now you have to think about, hey, how are we going to structure this deal? What kind of money do my investors want to put into the deal? Do they want to be debt partners, equity partners, or joint venture partners?
Yeah.
And all of those are crucially important. And I wanted to kind of break them down a little bit and talk about each of the different structures, just so that everyone understands what the differences are between them. Okay. The easiest one to start with is a joint venture. A joint venture just is two people or three people or maybe even four. Anything more than that is probably a little wishy-washy. It's a group of people that come together. They put in money. You can structure it however you want. You can split equity up any way you want. You could have a money partner and then a sweat equity partner. You could have everyone buys in a quarter or a third of a share equally and equally spreads apart the work. There's a ton of different scenarios. I mean, the sky is the limit on how you want to structure a joint venture deal, because everyone has to have a controlling interest and they also have to have an active input into the deal. Otherwise, they're considered passive, silent partners. And at that point, you have to do a syndication, right? When you're raising money from people that have no voting rights and no activity, no involvement in the deal.
Yeah, yeah, that's a really good point. And like I alluded to a few minutes ago, yeah, I'm actually involved in a few JVs. Quite frankly, they each bring their own unique challenges. Um, for instance, in the syndication deals, you got to worry about accredited versus non-accredited things like that. JVs, you don't tend to have that issue because everybody is an active participant. Um, and by the way, make sure you call that out when you're talking to your lawyers. Sometimes the lawyers will get a little bit confused about the way you're structuring your deal. Um, but in the JV world, to me personally, in the JV world, it's really really critical to have really good relationships with your JV partners. Um, Primarily because of what Vitali just mentioned. Um, oh, speaking of lawyers,
If you got questions on legal structure, reach out to this dude right here, Paul Vincent. He's the securities attorney, and he's actually got like a Facebook group and a mentorship group about deal structuring and things like that. So
why
he's an awesome guy to reach out to.
why is it Paul on here talking about this? He knows way more about these structures than I do.
Well, because he bores us with legal terms.
Uh, oh yeah, well, and it is
And he's a
daylight
bit of a
saving.
clown. That's true.
Yeah, daylight savings. I am struggling to stay awake right now, so maybe not. But anyway, hey, so and one thing I would say about JVs is make sure that you know who your partners are, particularly because of what Vitali alluded to. Is sometimes the breakdowns are not as clean. You may have somebody that brought all the money, and then you're part of the JV as boots on the ground, things like that. Sometimes it can get a little messy trying to understand who gets what and what the percentage breakdowns are based off what people bring to the table. Sometimes I'm of the opinion that the easy part's investing money, the hard part's making sure the business plan keeps on track and going. But a lot of times people will throw a huge amount of equity towards the person who's bringing all the money. So just keep that in mind. But yeah, a JV deal, quite different than a syndication. Yeah.
Yeah, have those conversations with your partners beforehand as well, before you start signing documents and spending money. Is lay out the expectation and everyone's involvement, so that everyone's happy with the equity slices and shares. So joint ventures are an awesome way to get into different deals depending on who you're connected with. I know that I'm currently working with a person that has a couple $100,000 in a 1031. It's too small of a number in order to 1031 and do a TIC, or tenants in common structure, in a syndication. So I'm looking at some smaller deals now where they can bring all of the money, and I can do everything else. And we'll split it maybe 50-50, 60-40, whatever. It doesn't matter. You just kind of have that conversation when you get there. So whenever you start to build these relationships with your different people that you're raising money from, find out what they're looking for and have a wide open view of what you can do with that money, and don't just get stuck on, hey, we got to put this money into a syndication and to move on to the next one.
Yeah.
There's a lot of opportunity out there to do a joint venture structure.
Yeah, and have those conversations. If I can speak from experience here for a second, especially on JV, have those conversations ahead of time, not after you have it under contract, not after you're ready to go take the deal down. Have it ahead of time, because again, those conversations about who gets what and who's compensated how can get pretty sticky. So go into the deal understanding how you want that breakdown to be.
Yeah, that's right. All right. The next type of money that you can find is equity partners, right? Those tie into your traditional syndications. You sell a share of your deal, and there's a percentage of ownership attached to that share. Whatever the splits are, it literally could throw a million different scenarios at you. That's again something you'll talk to Paul about when he goes through your PPM and asks you how many shares are you going to raise and how much equity are you giving to the investors. And if you're doing 10 shares and there's what's that, the 10 shares and 100% equity, everyone gets 10%, right? So you don't make any money. So those are traditional, what most people are comfortable with, and what you see kind of posted on Facebook all the time with 506c syndications, just traditional equity partners. And the last piece, debt partners. This is something that I'm learning how to leverage and use better. Speaking from experience, the last deal that we did, we almost raised 50% of the money that we needed for the deal as debt partners, essentially, because we paid them a 12% pref. They didn't share it and the upside equity. So essentially, it's like an interest only paid monthly loan of 12% or 1% a month. This is super powerful. I want to shout out, I don't know if Sam Silverman's watching me right now, but Sam Silverman's the one that gave me that idea when we were looking at this. And he said, wow, man, this deal cash flows so much you could split it up into two different tranches of shares as debt shares and equity shares. Why is that powerful? That is so powerful because you can still provide returns to your investors with a smaller equity slice. Okay. So that means that because the pool of investors is smaller, the pieces of equity that you also have to give away are smaller. Because remember, you're underwriting backwards, you're underwriting to meet investor returns. So the better deal that you find, the less equity you have to give away in order to still meet those investor returns. Right. It's to me, it seems logical, but it's in practice, it can be difficult because everyone says, I can't find a good deal. I can't do this. I can't do that. Blah, 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 blah. Right. At the end of the day. But there are good deals out there. So we are trying to leverage this more frequently because we realize the power of being able to provide options to our investors as debt or equity or JV partners now. I mean, you really have to have a whole lot of tools in your tool belt and figure out a way that you can give somebody options that is going to fit their needs. At the end of the day, it's always about what the investor needs, not what the syndicator needs.
Yeah, and Tim, maybe a little discussion around like why the debt deals have been hard to find or hard to do lately. Not hard to find. In my opinion, at least from what I've seen, those have been rare lately bec- primarily because of the performa and the cap rates that are going on, right? Like
Yeah.
to walk into a deal like that, you typically got to have some pretty good cash flow starting from day one, right?
Mm-hmm.
If you think about that, folks, you're like Tim just said, you're throwing a 12% pref at somebody, and it's hard to pay that 12% pref if the property's cash flowing 3, 4, 5% in year one.
Right.
Um,
Well, it's impossible to pay that pref.
right.
Well, unless you're raising equity in order to pay it out, but then you're kind of it's a double-edged sword. You got to raise more money to pay out more debt, which increases the amount of money that you have to pay out.
Yeah.
But at the end of the day, right, you're exactly right. Is a debt partner gets no equity upside. They're essentially interest only payments, and some people like that. And if you can provide that option to your investor where they can get paid monthly, like any hard money lender loan would do, or interest only loan would do, people like that. And I had a couple. We both had a couple investors that we were for sure thought that they were going to buy equity slices, and they're like, nah, I'd rather have the 12% paid monthly and get the refinance in 18 months and be done with it. And I honestly, I was shocked. I think it was my own limiting belief that people didn't want that option. That every single investor wanted equity upside, and that's not true.
Well, yeah, and I think some of the things we ran into too was like we just talked about. These types of deals are very rare right now. They have been for 2 years. These debt partner deals are pretty rare at the moment, at least in my experience. And we did run into quite a few people who are like, "Man, I got all kinds of equity deals going on. I got to create some cash flow, and here's a 12% cash flow deal for me." So I want some of that. And then we also ran into a number of people who were looking for a blended rate. They wanted
Mhm.
some equity, they wanted the cash flow, and by doing a little bit in each tranche, they were able to get like a blended 10% return and
Mhm.
some equity. Which to me, I mean that to me that's the home run right there. But that's me. That's my strategy. For guys looking for cash flow, looking to be able to put food on the table and things like that, that 12% return is really, really sexy.
Yeah. Yeah, yeah, yeah. And then, there's some things that I'm doing now when underwriting deals to see if we can raise more money as debt partners. And essentially, it's kind of like the Tim Bratz model, where you're giving away a very small percentage of equity. But instead, I'm going to start looking at it as, can we pay essentially a second position mortgage of 12 or 15% interest and we'll take no management fees, no acquisition fees, but we keep 100% of the equity at the refinance. And yeah, I mean, you got to have some other cash flow. You got to have some other things going on. It's definitely a little bit more risky. The deals are incredibly hard to find, but it's an option. You got to think about it at least. And I think that thinking of building the relationship with your investor will tell you what kind of investments they're looking for, essentially.
Yeah. Wait a minute. So now you're talking about diversification within your own investments as
That's right.
syndicator.
Right, that's right. Yeah, some of them are going to be more, I'm not going to get paid. I'm going to make all my money on the back end, but in the long run, I'm going to make significantly more money. And there are other deals where I'm like, oh, well, actually, let's give up equity on this one. I'm a little low on cash. I'd rather take an acquisition fee and give equity and upside to our investors. And when you start providing those options, you're also mitigating your own risk and future income and future earnings based on how you're structuring your deals today.
Yeah, and guys, we're not sitting here trying to say, which one's right, which one's wrong. Me personally, I like diversification, and I also like to do deals. I like deal flow. So if I can look at a deal 6 different ways and structure and have 6 different structures that I can go out and offer and keep deal flow going and keep things going on within my own book of business, and at the same time diversify my book of business, that's how I prefer to go about it. I know there are guys out there who have a very, very tight buy box, and they only want to do deals that sit in this model, right? And there's nothing wrong with that either. This is just like an investor. This is just how I prefer to look at things.
That's right. Yeah, I mean, we got a great question here: how to structure the debt partner agreement versus equity partners. So when you structure this agreement. And I just recently learned about this, and this is how we've done it. So I'm not saying that this is the only way to do it, just the only way I'm comfortable with it at this point in time, was all of the debt partners, the people that we got 12% pref payments with no equity upside, in the PPM, in the operating agreement, they actually own 1% of the deal. Now, all of the investors split up that 1%, which is a very menial, very small, almost, it's negligible amount of equity. Okay. I mean, some people were getting like 0.03% equity. I mean, you're not doing anything with that. Okay. And at the refinance, the GP or the managing members of the team, they purchase the shares out from the people that own them. So they're purchasing the very, very, very small pieces of equity. Plus, I think it's an extra, we did like $1,000. So, you get your 12% pref paid monthly. And then at the refinance, you get your $50,000 back, plus your monthly payment of whatever your interest payment was, plus a $1,000 buyout of your share. And then the operating agreement changes, and the managing members, the operating team of the deal, own 100% of the deal at that time.
Does that make sense? So I'm waiting for an answer there.
Yeah.
Like we're just talking here.
Right.
But this is where we should have Paul on, because Paul could explain that even better than us.
I'm sure he could, but this is good because we're explaining it in layman's terms.
Yeah. We'll lay it out there so you guys could actually understand it. But yeah, right. Hey, awesome that makes sense.
Cool.
I mean, this. I'll be honest. Like Vitali showed me this after he had that conversation with Sam, and it just kind of. Honestly, guys, it kind of blew my mind. I'd seen guys out there doing, debt deals, things like that, and this was like a blend. And I loved it. Yeah, all of a sudden, like the next 4 deals I looked at, I was like, how can I structure it like that one?
Yeah. It was amazing how fast we raised equity on that deal and debt on that deal, because there were options. Like I found out, like I had the duh moment of when people have options, they pick what's best for them. And before, I was having so many conversations with people, and we kind of structured our deals mostly the same way every single time. And they're like, man, it doesn't really fit what I'm looking for right now. I never asked the question of what they were looking for. I wish I had, because if they said, oh, well, I'll give you $100,000, $200,000, but I want 12% interest, I would just change the underwriting and figure out how to make that work. And if I have to drop my acquisition fee a little bit in order to make up for the difference, then I'm going to do that because I'm going to make more money in the long run than I would just today.
Yeah. So, uh, and really, so speaking of acquisition fees, back to JV deals, by the way, you know, one of the things that a lot of people have kind of a misconception on JV deals is that there's no acquisition fees involved, and that's not necessarily the case. I've done JV deals where there's no acquisition fee involved. I've also done JV deals where I received an acquisition fee, and part of the agreement was that I roll that back into the deal, and that's part of the way I purchase a piece of my equity. Boots on the ground, JV deal where I roll acquisition fees and technically no money out of my own pocket, right, to be part of a JV in that situation. So, I just bring this up because there's a lot of creative ways to get yourself involved in a deal. And there's also a lot of creative ways to structure deals themselves. So, just keep all those things in mind.
Yeah, and I think kind of going back to the topic of today is if you find the deal, the money will follow. And it's not true because you need to build those relationships with all these different types of people, the types of people that want to be debt partners, the types of people that want to be equity partners, the types of people that want to be JV partners. You need to learn what they're looking for and then provide a solution to their problem, right? Is their problem equity? Is their problem depreciation? Is their problem cash flow? Is their problem a 1031 that's too small to do a tenants in common, right? There's so many different scenarios that you can do by building relationships with your investors first and then going to find a deal that fits their needs, or at least keeping it in the back of your head and saying, hey, actually, I know a guy that might do something like this, and it doesn't work with XYZ structures, but it might be able to bring it to this guy and see if he's interested in doing it because he told me what he's looking for.
Yeah, yeah, and guys, if you think back to like when Sam Silverman was on a few weeks ago, he spoke to some of that, because I can't tell you how many times, and Vitali's been there with me. I can't tell you how many times I've looked at like deals in Arizona and California, and I'm like, who's doing these deals? Like, who is doing them? They do not work for me. And then Sam comes on and he talks about his guys that are like, hey, they're not looking for cash flow, they're looking for appreciation and equity plays. And it's like, your investor. Oh my God. No, it
Yep.
doesn't work for me because my investors aren't looking for that. But he knows his investors, and exactly what Vitali just said. He knows he's looking for he knows guys that are looking for equity and appreciation. So he goes and finds those deals. And really those deals are in California. Where the beautiful thing about low cap rates is that you add a dollar to the income and that dollar explodes on a low cap rate. The bad part about a low cap rate is that it doesn't tend to produce cash flow.
Yeah. Yeah. I think what did he say? It was the deals aren't in California, by the way. They're in Phoenix. That's he's looking at. But I think they're buying them at a sub 3 caps. But
Yeah.
he said the statistic is like every dollar that you put to the bottom line increases the value 30x. Like every dollar equals $30 because of the low cap rate.
No wonder he's raising money from tech folks, because those are the kind of returns. That's like a low return in the tech world.
Yeah, right. It is. That's wild, right? My God. Yeah, I'm glad you brought that up. That is considered a low return in the tech world because they're looking for those, moonshots.
They're looking for 200x,
200, 300x their money.
Yeah,
And that's how venture capitalists work. I mean, they invest in 100 deals and only one of them needs to work out in order to make it all worth it.
just need one.
Yeah.
Just need one. It's like digging holes in the ground in Texas, man. You just need one of those holes to start spurting black liquid, and you're good.
Black gold. Yeah. All right. So we talked about the different types of funds that you can get. Now we're going to talk about capital sources. Who can you raise money from? If you haven't started to build these relationships with people, you should already. This is just some information that I learned from one of the events that I was at a couple weeks ago. And they said some of the capital sources are your friends and family, your personal network, private equity groups, institutional equity groups, obviously the lenders, such as the bank. Like the bank is going to be your biggest investor. Other syndicators, people like me, I invest in other syndicators' deals because I want to capture market appreciation and mitigation of risk throughout different markets, because all the deals that we typically do are in the Sun Belt region. Well, there's also good deals in Pennsylvania, in Boise, Idaho, and Phoenix, Arizona. There's a lot of other people that are making money doing syndications that want to invest in other people's syndications because it's what I know, like, and trust. So don't not build a relationship with a syndicator thinking that they won't invest in your deal, because I've had quite a few conversations this month alone of people saying, "Well, I've been flipping a ton of houses and I've been doing some syndications, and the deals, are kind of running dry, and I got a lot of money. I got a lot of dry powder right now that they want to deploy. Do you got anything coming up?" They're like, "Oh, we trust Tim and Tim. I'm gonna put some money with them because I don't have anything myself." So don't count out other syndicators as potential investors in your deals. And then they said crowdfunding and typical accounts like a retirement, solo 401k, self-directed IRA accounts, and things like that. So go out there and ask a lot of people, where do they have most of their money? Like, what are they doing with their money? How are they investing it? And shut up and let them answer,
Yeah.
because they tell you how they're doing it. You can spot the problem that they don't even know that they have, and you can provide the solution. I mean, in full disclosure, there's a guy here locally that sold a piece of land, and when I first met him, he was talking about how he was going to put all the money with his financial advisor. He was going to collect his 5%, and he was never going to have to think about it again. And I was like, 5%? That's,
5.
I said, I could double that on a bad day. And so he took my card, and now we started talking, and now we're good friends. And, he's going to invest in quite a few of our deals because he's got some money put aside, and he trusts me now because I saw the problem that he didn't know he had. You don't know what you don't know. So talk to everybody about it and then provide solutions.
Nuggets of wisdom, man. Like, you're throwing it out there because, like, guys, Tim just threw out two things. One, don't be afraid to talk about what you do, because you never know when you're going to run across that guy who just doesn't know. And I've got a number of investors with me right now who all they knew was the stock market until they saw something or I said something, and they just asked me about it. And they're like, I'm looking for 5-6%, and I'm like, I could do that or more, easy. And then two, the other thing Tim threw out there is, I'll just go back to my own experience. I'm a syndicator. I have a belief in that I want my money working where I'm not. I put my active time into my own deals, so I want to double up. I want to have my money deployed where I'm not putting my time. So I put a lot of my money into syndications or JV deals myself as an LP in the syndications. And then two, you mentioned solo 401k. Guess what? I got a solo 401k. Actually, I have two because I manage my wife's for her. I can't be involved in those deals. So I'm a syndicator who is looking for LP opportunities where I can passively invest that kind of money as well. And that's so don't assume that just because somebody's actively doing syndication deals themselves that they won't look at LP opportunities. That's
Yeah.
that's not an open door to, like, hit me up for investment, by the way.
Hey, Tim, you got some money to place?
Not with you.
I don't have any opportunities right now. Well, yeah, I mean, that's so powerful. I mean, gosh, just investing, like putting your money to work where you're not working is a really good mindset to have. And I've actually had a lot of conversations in our mentorship group and people that wanted to be a part of it. And they want to learn how to be a syndicator because they don't like their jobs, or they think that being a syndicator, they're going to make more money. I'm like, well, how much money you're making now? And they're like saying 3, 4, $500,000 a year. I'm like, guys, you don't need to learn how to be a syndicator. You're not going to make 3, 4, $500,000 a year that quickly. You're going to start all over an entire new industry. You're better off sticking with your industry for another 3 to 5 years and investing as much money as possible and start to get onto that refinance structure. Like every 2 years, refinancing, you're getting that money back and redeploying it. Now you get cash flow and all these other types of things. And I always explain to them the Kiyosaki quadrants, right? Earned income, specialist income, business income, and investor. And I said, your earned income is from your job, which you make a ton more money than I do. And my earned income is from syndicating. But at the end of the day, if I stop syndicating, I stop making money. So I have to take the money that I earn as my earned income as a syndicator and invest it passively as an investor in order to meet those Kiyosaki quadrants and let my money work for me.
Yep. I just had a post about that recently. Exact same concept, and that's honestly where it comes from. Is from there. I take my active money, I put it over here, create passive income, so that I don't have to keep doing something. Don't get me wrong. I want to be syndicating for a long time. I love doing this kind of stuff, guys. Like it absolutely makes my day to get up and go tour a property. I love it. And I want to be doing this for quite some time, but maybe that changes in 10 years. And I want to make sure that I got that quadrant full, right? So that, when it does change there, I'm ready to roll.
That's right. That's right, man. You want to have the option to be able to step away from it and not have to do another deal and have to continue to grow and push and do all these things because you've built up that passive investment by taking the earned income from your syndications and investing it passively.
Yeah.
Superpower.
And then one other thing, like somebody asked, and you just hit on this, like what's the best way to get involved in a syndication? Um, I don't think there is a best way. Honestly, I think there are 100 different ways. You've got to figure out what fits your situation. Here's one thing I would say to you though. If you have the capacity to invest as an LP, you need to do it. It helps you understand the investor side of the equation. And I think some of the best indicators are the ones who understand what it's like to be an LP in a deal, to be a passive investor. And I'm not saying that to like create my network of people I can raise capital from. I'm saying that because I honestly, genuinely believe that is one of the best ways. In fact, I know a number of coaches who are doing and mentors who are doing, huge groups have been wildly successful in this world. And they will not take somebody who has not on as a mentor or a student. They will not take someone who has not invested as an LP before.
Yeah.
And it doesn't have to be in their deal. It just has to be an LP in somebody's deal, because they want to see that experience on their resume.
Yeah, taking action. I mean, it's hard. Wiring that first $50,000 share is difficult, right? You got to exercise that muscle, but once you do it for the first time, you're like, cool. How do I do that again? It's just like anything. Going to the gym the first time sucks. Wiring the money the first time for your investment sucks. Taking the risk the first time always sucks, but you get better and better and better and better at it the more you do it. So cool. All right, guys. Well, that's all we got for today. Thanks for tuning in, and we'll see you again next week. All right.
Have a great week, guys.
See you later.